Is this stock overvalued or not? Most common question in value investing. As you may already know, stock prices go up and down depending on multiple circumstances. That's why if you are interested in a specific stock, it is crucial to know when it's a good moment to buy or sell. For that reason, I am breaking down today a key indicator to know if a stock can be overvalued or if it is cheap. This is the price-to-earnings ratio, or in a shorter way, PE ratio. After this video, you will know what the PE ratio tells investors about a company's valuation, how to interpret it in different contexts, types of PE ratios, easy examples, and pros and cons of this ratio. Hey there, this is Mavic Finance, where investing concepts are explained in a simple way. But first, a quick disclaimer. Let's start with the basics. In the price-to-earnings ratio, at the top is the price, and at the bottom are the earnings per share. If you still don't know what earnings per share means, I will share an exclusive video about it at the right top of the screen, so you can watch it after this video. But basically, the EPS is a simple way to measure how much profit a company makes for each share of its stock. It's calculated by taking the company's total profit, after taxes and expenses, and dividing it by the number of shares that investors own. So this tells you how much of the company's earnings belong to you if you own one share. Back to the PE ratio. This formula is used to evaluate how much investors are paying for each dollar of a company's earnings. For example, if a stock is trading at $100 per share and its earnings per share is $10, the PE ratio would be 10. In simple terms, this means investors are paying $10 for every dollar the company earns annually. Technically, if earnings remain constant, it would take 10 years to recover your investment. But why does the PE ratio matter? Well, it helps you understand if a stock is potentially overvalued, undervalued, or fairly priced. Think of it as a way to measure the market's expectations for a company. In general terms, a high PE ratio might mean investors expect the company to grow quickly in the future. On the other hand, a low PE ratio might suggest the stock is undervalued or that the company is facing challenges. PE ratios can vary significantly depending on the industry, reflecting the differences in growth potential, risk, and business models across sectors. Here's a breakdown. High PE ratios are usually growth industries. Industries like technology, biotechnology, or e-commerce often have higher PE ratios. This is because investors expect these companies to grow quickly in the future, so they are willing to pay more for every dollar of current earnings. For example, a tech startup with innovative products might have a PE of 50 or higher, as investors anticipate significant profit growth. Low PE ratios, mature or cyclical industries. Sectors like utilities, manufacturing, or energy often have lower PE ratios. These industries tend to grow more slowly or have earnings that fluctuate with economic cycles, so investors are less willing to pay a high premium for current earnings. Negative or undefined PE ratios. Some industries, like early-stage tech startups or heavily indebted companies, may have negative or undefined PE ratios if they aren't profitable yet. In such cases, investors focus on other metrics like revenue growth or potential future profits. Each industry has its own normal range of PE ratios. For example, consumer goods companies often have moderate PE ratios, reflecting their steady demand. Comparing a company's PE ratio to the average for its industry is more meaningful than looking just at the PE ratio of a single stock. Let's imagine two companies in the consumer goods sector, Freshbite and Tasty Treats. Freshbite, with a stock price of $50 per share and earnings per share of $5 and a PE ratio of 10. And Tasty Treats with a stock price of $75 per share, earnings per share of $5 and a PE ratio of 15. Both companies are profitable and operate in the same industry, selling similar types of products. However, Tasty Treats has a higher PE ratio because investors expect it to grow faster in the future. Perhaps it has a new product line or a more innovative marketing strategy that gives it an edge. By comparing their PE ratios to the industry average, let's say the average PE for consumer goods is 12, you might conclude, Freshbite might be undervalued because its PE of 10 is below the industry average. Tasty Treats might be overvalued unless its growth expectations are realistic because its PE of 15 is above the industry average. However, there are different kinds of PE ratios. You'll often hear about two types: trailing PE and forward PE. Trailing PE looks at past performance using the company's earnings over the last 12 months. Forward PE is based on future earnings projections, which can give insights into where the company is heading. Both are useful, but they tell slightly different stories. Trailing PE is based on real data, while forward PE relies on estimates, and those estimates can sometimes be wrong. Imagine a company called Bright, which manufactures solar panels. The stock price is $100 and the last year earnings per share are $5. Trailing PE is 20. Now, analysts predict that Bright earnings will increase in the next year due to higher demand and improved efficiency. The projected EPS for the next 12 months is $10, so the forward PE is 10. The trailing PE of 20 is based on Bright actual performance over the last year. This is grounded in real historical data, so it reflects what the company has achieved. The forward PE of 10 is lower, reflecting optimism about the company's future. If analysts are correct, the stock appears cheaper based on future earnings. If the forward PE is lower than the trailing PE, it suggests that investors expect earnings growth. However, forward PE depends on estimates, and if Bright fails to meet these expectations, the stock might not perform as well as anticipated. Moreover, if the forward PE is higher than the trailing PE, this indicates that analysts expect the company's earnings per share to decrease in the future. For example, if Bright forward EPS projection were only $4 instead of $10, the forward PE would be 25. This could happen due to factors like increasing costs, reduced demand, or market challenges. Now, the PE ratio is a great tool, but it's not perfect. Let's look at some pros and cons. It is easy to calculate and interpret, even for beginners. It helps compare the valuation of companies within the same industry or sector. It gives us a quick overview of valuation. On the other hand, it does not account for long-term future growth potential. It can be misleading if earnings are temporarily inflated or depressed. It is industry-dependent, making comparisons less meaningful without context. It ignores debt and cash flow because it focuses solely on earnings. That's why it's important to use the PE ratio alongside other metrics that I will be explaining on this channel. That's all for today. We have learned that a low PE ratio doesn't always mean a stock is a good buy, or a high PE ratio doesn't always mean it's overvalued. It all depends on the context and the rest of the metrics. Did this explanation help? Let me know in the comments. And if you want to learn more about investing basics, don't forget to like this video and subscribe for more beginner-friendly tips. Thanks for watching, and I'll see you in the next video.